And when the legendary financier JP Morgan was asked how the market would behave, he simply responded, it will fluctuate. So the market fluctuates a lot, and as an investor, we have to brace up to meet up with the challenges posed by market volatility. That should not discourage us from investing, but rather we are expected to find ways and means and avenues of seeing how we could mitigate the impact of market volatility. And so in this video, I want to talk about two important ways of mitigating the impacts of market volatility. And that's why I'm considering the topic, protecting your portfolio using options and hedging strategies against volatility. So in this case, you could either use options to protect your portfolio. You may equally use hedging strategies. Let's start with using options for protection. Number one, using options for portfolio protection. So in this case, you could consider what is called a put option. Put option. So a put options gives you the rights, but not the obligation, to sell a stock at a predetermined price before a certain date. It gives you the rights, but not the obligation to sell a stock at a predetermined price before a certain date. The purpose here is to protect against potential decline in the price of the stock or a given index. So if the stock price falls, the value of the option will increase, and that will offset your losses. For example, if you own shares of of a stock and are concerned about short-term volatility, so the buying put options on those shares can provide a downside protection, because when the stock declines or plummets, that will increase the value of your put options on those stocks. We equally have what is called covered calls. Covered calls. A covered calls actually involve holding a stock while selling, a call option on the same stocks. You are holding the stocks, and at the same time, you could equally sell a call option, on that stock. And so, what is the purpose? The purpose is to generate income from the premium received, for the call option, which can offset potential losses from volatility. The essence is to see how you could mitigate the risk inherent in stock market volatility. However, it limits potential upsides because if the stock happen to rise above the strike price, the stock will be called away. The stock will be called away. It is called covered calls. For example, if you expect the stock to remain relatively stable or increase in price slightly, selling calls can provide income while mitigating some downside risk. When you sell calls, it gives you income, and at the same time it protects you against downside risk on the stock you own. There's another important factor that is called protective collar. Protective collar. A protective collar combines buying a put options and selling a call option on the same stock. That is, on that same stock, you could buy a put option, and at the same time you could equally sell a call option on the same stock. And the purpose here is to offer protection from large losses through the puts while generating income to render the cost of the puts, through the call. Let me take it again. It offers protection for large losses, through the put, while at the same time it generates income to reduce the cost of the put through the call. This strategy can be used when you want to limit losses during volatility, but are willing to cap potential gains. If you can sacrifice potential gains, then a protective collar is a very good time. It's an excellent way of mitigating losses that could arise through volatility. For instance, now if you own a stock and you want to hedge against significant downside risk, but you are also willing to limit your upside potentials. You want to limit your downside risk, and at the same time, you want to also, place a cap on your upside potentials. And this strategy, creates what is called, a collar, like a collar around your stocks. Now, let's look at our hedging strategies. You could use what is called inverse ETFs. All right. So inverse ETFs are designed to move in the opposite direction of the underlying assets, or index. In other words, if the index plummets, the underlying assets, or rather, if the underlying assets, plummets, the index will rise, and the index, rises, the asset itself will plummet. It's that particular inverse relationship. And so if you expect, the purpose here is to, is to be utilized in hedging, against market declines as they gain value when the market falls. That's how it operates. When the market falls, you achieve a kind of gains, and when the market rises, you sustain losses. For example, if you expect market volatility to lead to a decline, an inverse ETF tied to the Standard & Poor 500, or another broad index can provide protection as the broader market declines. So it gives a kind of protection against market decline. It acts in an inverse pattern. If the market declines, you gain. If the market increases, if the market rises, you tend to lose. Then we equally consider diversification. So this is one of the most straightforward hedging strategy an investor could use. You spread your investment across different assets. It could be bonds, it could be stocks, it could be ETF, it could be index fund, it could be real estate, it could be commodities. You simply spread your assets, across different asset classes because these different classes don't move in unison. There is no correlation between these different asset classes. If stock is doing well, the bond market may not do well. If the bond market is performing very well, the stock market may not perform very well. Something is applicable to commodities and to real estate. So it is there to be able to help you to maintain a balanced portfolio and to guide against risk. And so if you own a portfolio of stocks, adding assets like government bonds or commodities can help mitigate the impact of stock market volatility. Another important factor we could consider here is what is called the volatility index option. Volatility index option, or the VIX option. The VIX here is often called, it's often called the fear index or the fear gauge. It measures, expected volatility in the stock market. And the purpose here is, buying options or futures on the VIX can be an effective way to hedge against, increasing market volatility. So you could buy, you could buy an option. You could also buy, a future on the volatility index to help you guide against declining stock prices as a result of market volatility. For example, if you expect volatility to rise, purchasing VIX calls, can help offset losses on your stock portfolio during period of high uncertainty. If you expect that there will be, you expect, but the level of volatility will rise in the market, what do? You simply buy a VIX call, all right, and that will then, offset losses in your portfolio as a result of you know uh, during a period of uncertainty in the market. They also want to consider what is called currency hedging. In the case of currency hedging, this is very, very important for international investors. So this will help you to mitigate against the risk of foreign exchange volatility. You invest, you invest outside the domestic, your domestic country, your country of residence is important. You get currency hedging. You hedge against, the currency of the country you are invested in. So it protects against, changes in the currency value that can affect results. For example, if you hold foreign stocks using currency options or ETFs that hedges against exchange rate fluctuation, can reduce the impact of currency volatility on your overall returns. We also want to consider asset allocation. So asset allocation here refers to adjusting the proportions of different, assets classes on your portfolio to reduce risk. You adjust your proportions, to reduce level of risk. So the purpose here is that during times of high volatility, shifting more assets into safer investment like bonds, like cash, can help protect you against the inherent volatility in the equities market. In case a decline in the equities market, it will not affect your overall portfolio because you are equally invested in bonds and even cash. So, for example, if the stock market is highly volatile, the investor might allocate more to fixed income like bonds and cash equivalents to avoid large losses. And this is how you hedge against, potential, impact of volatility, on your portfolio. Don't run away. Don't be scared by volatility. Adopt this method to see how you could hedge against them.